Hello, friends. I'm going to talk about behavioral strategy driven investment advisory for bias mitigation. Investment success is not determined solely by intelligence, information, or analytical ability. More often, it is influenced by human behavior. Investors frequently make decisions based on emotions, cognitive shortcuts, and psychological biases rather than rational analysis. Fear during market declines, greed during bull markets, overconfidence after a few successful investments, and panic during uncertainty can significantly reduce long term wealth creation. This is where behavioral strategy driven investment advisory becomes invaluable. It combines financial planning with behavioral science to help investors recognize and overcome biases, enabling them to make disciplined, goal oriented investment decisions. Behavioral finance has challenged the traditional assumption that investors are always rational. Nobel Prize winning economist Daniel Kahneman and Richard Thaler demonstrated that emotions and mental shortcuts often influence financial decisions. As a result, the role of a financial advisor has evolved from being merely a product distributor to becoming a behavioral coach who guides investors through uncertain market conditions. One of the most common behavioral biases is loss aversion. Research suggests that people experience the pain of losses much more intensely than the pleasure of equivalent gains. Consequently, the investors often panic during market corrections and redeem their investments at precisely the wrong time. A behavioral strategy driven advisor educates clients that market volatility is a normal part of long term investing and encourages them to remain invested according to their financial goals rather than reacting to short term market movements. Another major bias is recency bias, where investors assume that recent events will continue indefinitely. During prolonged bull markets, they believe markets will keep rising forever and invest aggressively. Conversely, after sharp market corrections, they assume markets will continue falling and stop investing. Advisors help clients understand historical market cycles and remind them that markets have always experienced phases of growth, correction, recovery, and expansion. Overconfidence bias is particularly common among experienced investors. A few successful stock selections often create the illusion that future outcomes can be predicted with certainty. This leads to concentrated portfolios, excessive trading, and underestimation of risks. A behavioral advisor emphasizes diversification, asset allocation, and humility in investing, ensuring that decisions are based on evidence rather than confidence alone. Confirmation bias causes investors to seek information that supports their existing beliefs while ignoring contradictory evidence. For example, an investor who strongly believes in a particular sector may only read positive news about it while dismissing warning signs. Advisors counter this tendency by presenting balanced data, encouraging objective analysis, and promoting diversified investment strategies. Another significant challenge is herd behavior. Investors often follow the crowd because they fear missing out on opportunities. Whether it is technology stocks, thematic funds, cryptocurrencies, or any trending investment, people tend to invest because others are also doing so. Unfortunately, the herd behavior often results in buying at high valuations and selling during panic. Behavioral advisors encourage clients to focus on their personal financial goals rather than the market hype. Anchoring bias also affects investment decisions. Investors become emotionally attached to a particular purchase price and refuse to evaluate investments objectively. They may continue holding poor quality investments simply because they expect prices to return to their original purchase level. Behavioral advisors shift the discussion from purchase price to future prospects, portfolio suitability, and long term objectives. Behavioral strategy driven investment advisory relies on structured processes rather than predictions. The first step is understanding the client's financial goals, risk tolerance, investment horizon, cash flow requirements, and emotional behavior. Every client has a unique behavioral profile. Some are naturally conservative, while others are aggressive. Some panic during volatility, whereas others become over enthusiastic during rallies. Understanding these traits allows advisor to traitor, to tailor communication and investment strategies accordingly. Goal based investing is another powerful behavioral intervention. Instead of focusing on daily NAV movements or index fluctuations, advisors help clients associate investments with meaningful life goals such as children education, retirement, home ownership, healthcare, or financial independence. When investments are connected to life aspirations, investors become less reactive to short term market noise. Asset allocation serves as one of the strongest behavioral safeguards. A carefully designed allocation across equity, debt, gold, and other suitable asset classes reduces portfolio volatility and emotional stress. Investors with diversified portfolios are generally more comfortable staying invested during market corrections because they understand that different asset classes perform differently under varying economic conditions. Systematic investment plans, very commonly known as SIPs, are excellent behavioral tool. Rather than attempting to time the market, SIPs promote disciplined investing irrespective of market conditions. During market declines, investors accumulate more units at lower prices, while during market rallies, wealth compounds over time. Investors should consistently reinforce that volatility is not the enemy, emotional decision making is. Regular portfolio reviews also play an essential role in behavioral advisory. Instead of reacting to daily market fluctuations, clients should have scheduled review meetings where progress is measured against financial goals rather than short term returns. Such reviews reduce anxiety and discourage impulsive investment decisions. Technology has further strengthened behavioral advisory through automated alerts, risk profiling tools, investment dashboards, and periodic reminders. However, technology alone cannot replace human empathy. During periods of extreme uncertainty, investors seek reassurance, perspective, and confidence from trusted advisors. This human connection often prevents costly emotional mistakes. For mutual fund distributors and wealth managers, behavioral advisory represents a significant opportunity to create long term value. Product knowledge alone is no longer sufficient. Successful advisors educate clients about emotions, behavioral biases, financial discipline, and long term wealth creation. They become trusted partners who guide clients through both market booms and downturns. The future of investment advisory will increasingly focus on integrating behavioral insights with data analytics and artificial intelligence. AI can identify patterns in investor behavior, predict emotional triggers, and provide personalized communication. However, the advisor's ability to build trust, understand human emotions, and motivate disciplined investing will always remain irreplaceable. Behavioral strategy driven investment advisory is not about predicting markets, but managing investor behavior. Markets will always fluctuate, economic cycles will continue, and uncertainty will remain a constant feature of investing. What investors can control is their own behavior. Advisors who help clients recognize and overcome biases create lasting value that extends far beyond investment returns. They build confidence, encourage disciplined investing, reduce emotional mistakes, and help clients stay committed to their long term financial goals. In today's increasingly complex financial world, the greatest alpha may not come from selecting the best fund or stock, but from helping investors make better behavioral decisions consistently over time. Thank you.